Hello and welcome back to a video on time series modeling. If you follow the financial markets, you will have probably seen people try to provide exact forecasts for stocks in next days or weeks. And on the other hand, there are also people who think the stock market is a casino. And in this video, I will show you that neither extreme is the case. My name is Jimmy Lapping, I'm a psychologist and statistician and regularly share videos on my channel about different kinds of research topics, including the financial markets. And in this video I discuss an automated time series approach called Auto-ARIMA, on which you can find documentation via the link provided, and which accounts for the serial correlation in the time series and provides an interval forecast for a stock for a next day or week. As always, none of the content of this video is meant to be used for trading, investment, or financial advice. I am just sharing my analysis to show what you can do yourself as part of your own research on stocks or other types of financial subjects you may be interested in. So here you see the one-year trajectory of 4 stocks listed on the Amsterdam Midcap Index that have clearly different trajectories. And if we are interested in trying to forecast where each of these stocks is headed for the next day or next week, well, the question arises which kind of indicators we can base our forecasts on. If you have been following the financial markets at least for a while, you will probably have heard of moving averages and that they are used by traders to make buy and sell decisions because, based on these moving averages, they expect a stock to go in a particular direction. Yet in a previous video, for which you can find the link here, I provided some evidence showing that there is little reason to believe such moving averages are actually useful for predicting future performance. In that video, I use Bitcoin as an example, but the same kind of research I've done on precious metals and stocks has resulted in the same conclusion. So if moving averages are not useful, what is useful? Well, one type of indicators that I have found to be more useful than moving averages and is also used across the world are so-called support and resistance levels, with resistance referring to a recent low and support to a recent high. Now, different people may have different definitions of what exactly is a support or resistance. In my analysis, the upper and lower horizontal dashed line that you see here are the highest low and the lowest high, respectively. So the highest daily low and the lowest daily high, respectively. And these provide approximate levels of resistance and support in my analysis. And the middle dashed line is the median daily closing price in this time window, which provides somewhat of a central tendency statistic and helps to understand where a price is currently relative to that center. But these are just reference lines that are not meant to serve as point forecasts for future values. So this brings us to Auto-ARIMA, which is the function that is part of the forecast package in the open source program R and helps to find the best time series model for a given stock or for another subject's time series for that matter, using a predefined information criterion. Now, I'm not going to discuss all the technicalities of this package because these can be found via the link displayed here. And I will just say that for the remainder of this video, I have used the default settings of that function as documented on the page you can find via the link here. And what I am particularly interested in is to use the 90% confidence interval as a prediction or forecasting interval for the next day or week. The idea of this interval is that a point forecast will rarely come true because a stock market is a complex environment that cannot be forecasted exactly. But if the model chosen by the Auto-ARIMA function is appropriate, the resulting 90% confidence interval around that point forecast should include the actually observed value on the day or week forecasted in about 90% of the forecasts. So this is one of the things that I have extensively studied, and in the remainder of this video I provide 2 of several tests that I have run as part of this research on the behavior of the 90% confidence interval resulting from forecasts with the Auto-ARIMA function. In the first test that I'm going to show, I included a sample of 15 stocks listed on the Amsterdam Stock Exchange. These are European stocks that are denominated in euros, listed in Amsterdam. The reason for taking the Amsterdam Stock Exchange is that is one of the stock exchanges that I follow most closely. Now, this sample is a mix of large, mid and small cap stocks, and together they represent nearly all the sectors of the stock market, the utility sector being the exception. And I used the weekly closing price of each of these stocks during 2017 all the way to the end of 2023. So a total of 7 years of data, weekly closing data, adjusted for dividend. For each of these stocks, I ran a total of 13 forecasts for the dates that you can see on the right, dates which are about 5 months apart, and as a sample represent all calendar months. Now, for each forecast, we use the previous 104 weeks, which is about 2 years of data. And given that for each of 15 stocks, we get a total of 13 forecasts, which we can compare with the actually observed value on the given day that we made a forecast for, we have a total of 195 comparisons. So let's have a look at some of the findings. First of all, the histogram gives an idea of the distribution of the residual, which is defined as the percentage of difference between the actually observed value and the point forecast, with positive values indicating that the stock performed better than the point forecast, and negative values indicating that the stock performed worse than the point forecast. And around that histogram, we see some tables from which I have highlighted some useful statistics. To start, on the left, you see which models were selected most. You see which models were selected, but then in the red square, those were the 2 models that were selected most. These 2 together accounted for about 75% of the choices. So that's quite a lot. It's usually a difference model, and the WD that you see in the second model, that means with drift. So there was a drift component included as well. Next, on the right, you see, among others, the mean and median residual, as well as the 5th, 10th, 90th, and 95th percentile of the residual distribution. So we see that the central tendency is around 0. The middle 80% of the distribution includes all residual values of about plus and minus 5.5%, and the middle 90% of the distribution includes all residual values of about plus and minus 8%. In other words, forecasting on a week-to-week basis is not easy. Yet in the 2 tables under the histogram, we see that the 90% confidence interval included the actually observed value in about 90% of the cases, and that in about 5% of the cases the observed value was lower, and in another about 5% of the cases the observed value was higher than the interval. This distribution is almost perfectly in line with what one would expect given the theory around the 90% confidence interval, and the Bayes factor here is well over 300 in favor of the null hypothesis of the distribution for the 90% confidence interval, which says 5% of the times the actual value is below the interval, 5% of the times it's above the interval, and in 90% of the cases it's included. So this is the distribution that we find is really plausible under the null hypothesis. Next, I took the 1-year trajectory of 4 stocks from the sample until last Friday's close, which is the 16th of February 2024. So this yields a total of 256 data points for each stock, because yes, it's a 1-year trajectory, but of course in the weekends you don't have data, and there are a few bank holidays, for instance around Christmas and Easter, during which stock markets are closed. So you have a total of 256 data points for this 1-year period. For each of the 56 forecasts, so that's the last 56 values in this time window, I used the previous 200 daily closing prices. So this yields a total of 224 comparisons. Now here you see the same output as we saw previously for the second test. And what we see here, first of all, the frequency distribution of different models on the left is quite different now than it was for the weekly forecasts, no? Because in the second test, well, we deal with daily data to predict the performance for the next day, whereas in the first test we were trying to predict the end of next week with weekly data. Now on the right, again, the mean and the median are close to 0. And the residual distribution now has considerably less dispersion than for the weekly data. Look, for instance, at the percentiles, which are now much closer to 0. I mean, they are not close to 0, but they are much closer to 0 than they were in the first test. For the first test, the 10th and the 90th percentile were around 5.5. And at the 5th and 95th percentile, they were at around 8. So you see, now we are dealing with daily data, and they are much closer to 0. We see that the 90% confidence interval includes the actually observed value in just over 93% of the cases, and the resulting distribution does not differ significantly from the 5 to 90 to 5 distribution that one would expect under the null hypothesis of a correctly functioning 90% confidence interval. And you see that the Bayes factor is in this case about 70 in favor of the null hypothesis. Okay, so to round off, I will provide an example of the forecasts for the last day in the series in this second test. In this table, the forecasts are based on the 200 trading days preceding Friday, 16th of February 2024, and are made about that Friday, 16th of February 2024. As already mentioned, actually observed values rarely coincide with point forecasts, but the confidence interval is supposed to include the actually observed value in about 90% of the forecasts. Here in this example, it happens to be that the interval includes the observed value in all 4 cases. But okay, this is just a sample of 4, a one-time observation. And well, 2 more observations can be made about this table. To start, as we can see in the second left column, so the model column, each stock was forecasted using a different model, and this cannot be seen in the table, but I can tell you that this model, the model that is chosen for a particular stock, tends to vary across time as well, because the trajectory of a given stock changes for all kinds of reasons. Now, secondly, in the second right column, so this is in this case the percent margin column, we see the approximate percentage of margin around the point forecast provided by the model. That is the distance from the point forecast to the lower or upper bound of the 90% confidence interval. Now for AMG, for instance, which is the AMG stands for AMG Critical Materials. It is a company in the basic materials sector, and then within that sector in the critical materials industry. and especially big in lithium. So the margin here is considerably larger than for the other stocks because, well, this has been much more volatile than the other three stocks and therefore, well, is somewhat harder to predict. Energy stock SBM Offshore, on the contrary, which you see in the last row of the table, has been moving sideways in a relatively narrow range lately. So resulting in a sideways point forecast with, in percentage terms, a considerably narrower 90% confidence interval. And of course, an interval is not meant to give a precise forecast. Rather, it can help to remind ourselves that precise forecasting in the stock market is difficult, if not impossible. At the same time, the stock market is not a casino either. If it was a casino, a stock would just take any random value in any given day or week, and it would be pointless to do any kind of forecasts, whereas the trajectory of a stock, like so many types of time series that are out there, tends to be such that values in a given range are much more likely than values outside that range. And that explains why, as long as the model is appropriate, the 90% confidence interval can actually include the actually observed value in that on that time point forecasted in about 90% of the cases. Having said, that's it for this video, which I hope is helpful. If you have any ideas or suggestions for future videos, just leave a comment below this video or contact me via the email address that I have shared in the description below this video. Thank you for listening and see you soon.